Yo, Asian guy here. If you're new, I'm the dude who lives in the uncomfortable details zone. The stuff people skip because it messes with the nice, clean story. And listen, something historic just happened in the silver market. If you don't understand what it signals, you could walk straight into a trap that's been building for years. While most people were distracted by holiday celebrations, while Western markets were closed, while traders were off their desks, physical silver in retail shops across China reached $91 per ounce. Right now. Not theoretical, not projected, not some analyst's forecast. Real transaction pricing. Actual deals being executed. Metal changing hands. And at the exact same time, COMEX, the exchange that's supposed to set the global price of silver, was still sitting around 79.59 DANs. That's not normal. That's not market noise. That's not a cute little temporary dislocation that magically smooths out when everyone gets back to work. That's an 11. It's an 41 gap between what physical silver actually costs and what paper contracts claim it's worth. And that gap is about to force a reckoning when markets reopen Monday morning. Before we dive in, I need to be crystal clear. Nothing here is financial advice. I'm not telling you what to buy or sell. I'm presenting facts, mechanics, and historical patterns. You're responsible for your own decisions. If you want real-time breakdowns like this, the kind mainstream coverage won't touch because it's too uncomfortable, too revealing, too dangerous for the narrative they're trying to maintain, subscribe and turn on notifications. And drop a comment. Do you own silver? Or are you watching from the sidelines? Because what happens when markets reopen on Monday could be fast, violent, and irreversible. And your position, whether you're long, short, or sitting in cash, will determine whether you profit or get crushed. In this investigation, I'm going to show you exactly what this $11.41 gap means and why it's different from normal premiums. I'm going to explain the Monday trap, the two scenarios that could unfold when Western markets open, and why both scenarios involve violence. I'm going to detail why retail pricing in China matters more than most analysts understand, and why it's the canary in the coal mine for the entire silver market. I'm going to break down the structural weakness in paper markets and why the arbitrage mechanism that's supposed to close gaps is actually exposing them instead. I'm going to show you the industrial demand drivers that make physical demand inelastic and why that inelasticity creates explosive price moves. And I'm going to give you the specific signals to watch Monday morning so you know which scenario is playing out. This is the story of the $91 silver shock, the day Shanghai printed reality while COMEX clung to fiction, and why Monday will force the paper market to choose between capitulation and chaos. Here's the core situation. Focus on these numbers because they're not opinions, they're not models. They're verified data points from the physical market, physical retail silver in China near $91 per ounce. COMEX paper reference approximately $79.59. That's a split market, two prices for one metal. One price where actual physical transactions occur, another price where financial contracts trade. And when that happens in any critical commodity, when physical and paper diverge by more than 14%, the resolution is almost never smooth. It's forced. Now, let me be precise, because skeptics immediately jump in with, those are retail prices. Retail always has premiums. You're comparing apples to oranges. And yes, retail shop pricing includes premiums. That premium isn't automatically manipulation or gouging. It reflects real costs, fabrication costs, turning raw silver into bars or coins, availability costs, immediate delivery versus waiting, logistics costs, getting metal to the shop, and urgency costs, the premium that appears when supply is tight and buyers compete. All legitimate components of retail pricing. But here's what matters. Even after accounting for those premiums, after stripping out the normal markup retail always carries, when physical clears this far above paper, it's telling you something uncomfortable. The screen price is becoming less relevant than the delivery price. Think about what that means. For decades, COMEX set the price. Miners used COMEX as a reference. Manufacturers used COMEX as a reference. Investors used COMEX as a reference. The paper price was the price. But when physical markets in China are transacting at $91 and paper markets in New York are showing $79.59, the question becomes, which one is real? Which one reflects actual supply and demand? Which one can you actually execute at if you need metal? And the answer is increasingly clear. The physical price is real. The paper price is lagging, and when the delivery price starts leading, paper pricing loses authority. It becomes a derivative, a secondary indicator, something that follows rather than leads. Now, once that psychological shift happens, once market participants stop trusting the paper price, the paper market loses its control. This is the Monday trap. When Western markets reopen, this $11 gap has to resolve. It cannot persist indefinitely. The market will force resolution, but resolution can happen in two very different ways. Understanding both is critical. Scenario A, paper chases physical. COMEX gaps up and starts catching the $91 reality. Maybe it opens at $83, maybe $85. It jumps to close the gap. That triggers short covering. Traders who sold silver at $77 or $78 are now underwater. Brokers call for more margin. Some panic and cover. Their covering is forced buying, pushing price higher. That triggers stop-loss orders. Traders with stops at $82 or $83 get hit. Those stops become market orders to buy. More buying pressure, more upward momentum. Then algorithmic trading kicks in. HFT systems detect the breakout and pile in. That creates a cascade. Price moves like an elevator, not stairs. It doesn't climb gradually. It jumps. $79 to $83 to $86 to $89 in a matter of hours, maybe minutes. That's what happens when paper finally capitulates to physical reality. The adjustment is violent because it's been delayed. The gap that should have closed gradually over weeks gets closed in hours. All the buying pressure suppressed by denial suddenly releases at once. Scenario B. Paper tries to crush the narrative. Heavy sell programs hit the open. Large institutional sellers, possibly bullion banks who are short, dump massive quantities of futures contracts within minutes. The screen goes red. Price drops from $79.59 to $77 to $75. Headlines scream, silver crashes, China premium was fake. Retail traders panic and sell. Stop losses get hit on the downside. And the narrative becomes, see, the physical premium was temporary. The real price is what COMEX says. Everyone calm down. This is psychological warfare. The goal isn't to reflect supply and demand. The goal is to convince everyone the paper price is the real price and the physical price is an anomaly. To shake out late buyers, to restore confidence in the paper reference, to prove COMEX is still in control. But here's the problem with scenario B. It only works if physical demand cools off. If after the smash, Chinese buyers shrug and stop paying $91 if dealers lower asking prices. Dealers lower if the physical market accepts the paper market's verdict. But what if they don't? What if shops across China are still clearing near $91 after COMEX drops to $75? Then the gap just got wider. It went from $11 to $16. And that wider gap proves the opposite of what the smash was trying to prove. It proves the physical market doesn't care what COMEX does. It proves physical demand is real, urgent, and inelastic. And once that's proven, the smash fails. Price recovers within hours or days, and when it recovers, it goes higher than before, because the smash shook out weak hands, transferred silver from panicked sellers to strong hands, and proved the physical market is leading. So Monday becomes a test of control. Does paper successfully intimidate physical, Or does physical reality drag paper upward? Either way, volatility risk is high, especially for leveraged traders. If you're trading with 10x or 20x leverage, scenario B can wipe you out, even if you're right about the long-term thesis, right about physical demand, right about supply shortage, right about the direction. If you get stopped out in a flash crash, you're out. You don't get to participate in the recovery. This is why leverage is dangerous during structural transitions. The path might be correct, but the volatility can destroy you. Comment below. Does the gap close up or close down? And do you believe the physical market is starting to lead price discovery? Because that's the fundamental question. Is this just a temporary premium that fades, or the beginning of a permanent shift where physical asserts authority over paper? Now, a lot of people hear China shops and assume it's irrelevant. That's just retail, not the real market. The real market is COMEX or LBMA. Wrong. Completely wrong. Here's why. Retail pricing is where physical tightness becomes visible first. Retail has one brutal rule. When a metal is scarce, its price adjusts immediately. There's no smoothing, no managing, no PR spin. If a dealer has limited inventory and 10 buyers want it, price goes up until only the most urgent buyers remain. That's supply and demand in its purest form. Paper markets can delay reality. They can manage perception. They can use derivatives to create synthetic supply. They can roll contracts forward to avoid delivery. They have tools to maintain the fiction that everything is fine. Retail can't. Retail is cash and carry. You pay, you get metal, or you don't. No complexity, no rolling, just physical settlement. And when enough buyers are willing to pay nearly $91 in the real world, that does two things. First, it pressures wholesalers and refiners upstream. If retail sells at $91, wholesalers need to charge retailers $89, or retailers can't make margin. If wholesalers pay $89, refiners need to charge $87. If refiners are paying $87 for raw, miners can charge $85. The retail price sets the floor for the supply chain. It flows backward. Second, it changes psychology. People see the screen price, go to buy, and get quoted $91. Cognitive dissonance hits. Which price is real? Increasingly, they conclude the real price is what they have to pay, not what the screen shows. That's how narratives break. Because the price isn't what a screen says, it's what a seller will actually hand you metal for. And right now in China, that price is $91. Now, why does China specifically matter? China isn't a small retail market. It's the manufacturing center of the world. China makes solar panels, electric vehicles, electronics, batteries, all of it. And all of those products require silver. The Silver Institute has highlighted how industrial demand has been driven by the green economy, including photovoltaics and EVs, and noted China's massive solar build-out, like newly added solar capacity reaching a record 278 gigawatts in 2024, per Metals Focus research referenced by the Institute. The Silver Institute. So when Chinese retail shops are pricing silver at $91, it's not just retail investors buying. It's procurement managers from factories. It's industrial buyers securing supply. It's manufacturers hedging against future shortages. These aren't speculators. These are people who need physical metal to keep production lines running. They're willing to pay $91 because the alternative is worse, waiting and hoping metal becomes available later, risking production delays, losing contracts because you can't deliver products. So they pay $91, secure the metal, and move on. Their buying keeps the price elevated. This is different from speculative demand. Speculative demand is elastic. Price rises, speculators back off, wait for pullbacks, trade volatility. Industrial demand is inelastic. Price rises, industrial buyers absorb it, because demand is tied to production needs, not price levels. And that inelasticity is what makes physical markets powerful. Once physical demand tightens, price becomes the only adjustment mechanism. And price can rise much further than models predict because models assume demand is elastic. But in industrial markets, higher prices don't necessarily reduce demand. They just transfer cost to customers. Solar panel costs go up, EV costs go up, smartphone costs go up. Customers pay. Production continues. Silver demand continues. Now we need to talk structure. Why the paper market is vulnerable when physical tightness emerges. COMEX is a futures exchange. It allows traders to buy and sell contracts representing future delivery of silver. And yes, one standard COMEX silver futures contract is for 5,000 troy. Most activity is financial settlement. Contracts are rolled, closed, or cash settled. Only a small fraction results in actual delivery. The system works beautifully as long as two conditions hold. 1. Physical demand stays calm. Most participants are trading price exposure, not metal. 2. Confidence stays intact. Everyone believes delivery is available if needed, so paper maintains authority. But when either condition breaks, the weakness shows. Paper is leverage. Physical is final settlement. Let's talk leverage. To buy one COMEX silver contract representing 5,000 ounces, you don't need to put up the full notional value. You post margin. CME publishes silver futures margin schedules, and the key idea is you control a huge position with a relatively small amount of money, meaning leverage is baked into the structure. CME Group. That leverage enables speculation, price discovery, liquidity, but it also means the paper market can represent far more silver than exists in deliverable form. The narrative you need to understand is this. The system can handle delivery when only a tiny percent ask for metal. But if that percent rises, if industrial buyers and arbitrage players start demanding delivery, the stress shows up fast. Delivery delays, rule changes, cash settlement, chaos. And here's the part textbooks get wrong about arbitrage. Textbook theory says, buy cheap in New York, ship, sell high in China, gap closes, easy profit. Reality says arbitrage requires metal, time, logistics, approvals, and inventory that can actually be delivered. The actual arbitrage process looks like this. Step 1. Buy COMEX futures at $79.59. Step 2. Request physical delivery. Now it gets complicated. You need an approved warehouse receipt. You coordinate with the vault. You wait for the delivery window. Could be weeks. Step 3. Once you have metal, arrange shipping to China. International shipping, insurance, customs documentation, export approvals, import approvals, more weeks, more cost, more risk. Step 4. Sell in China at $91. But by the time you finish steps 1 through 3, price may have changed. You're taking price risk the entire time. And here's the critical insight. When tightness is real, when physical supply is constrained, arbitrage doesn't close the gap. It exposes it. Because the more people try to pull metal out of paper systems, the more stressed the system becomes. Registered inventory drops. Delivery delays increase. Premiums widen. The act of arbitrage proves the shortage is real, which attracts more arbitrage attempts, drains more inventory, proves the shortage further. That's a positive feedback loop. Quietly at first, small premium appears. It grows. Then it becomes obvious. The paper market doesn't have the metal to satisfy arbitrage demand. Now we've got to address demand, because silver isn't just an investment story, it's a supply chain story. And the demand drivers don't pause just because price rises. Solar. Solar panels require silver paste for conductivity. The PV industry is shifting toward higher efficiency technologies like TOPCon, which multiple studies and industry discussions point out can mean higher silver requirements for screen-printed metallization. And per the Silver Institute's own reporting tied to World Silver Survey research, PV growth has been heavily led by China's massive capacity additions. The Silver Institute electrification. The global economy is electrifying. EVs, heat pumps, induction stoves, electric trains. Every time we plug something in, we need more circuits, more connections. And silver is famously the most electrically conductive element. Whatco. So as electrification expands, silver demand pressure stays on. EVs. A regular car uses around 15 to 20 grams of silver. EVs can use more. Industry estimates commonly place battery electric vehicles in a higher range, like 25-50 grams per vehicle, and the Silver Institute itself has discussed BEVs in that neighborhood. The Silver Institute Electronics. Your smartphone, tablet, laptop, TV, even your fridge, silver is in there. Some sources estimate around 0.2 to 0.35 grams of silver per smartphone, which sounds tiny until you multiply by billions of units. Gibraltarira.com. And global smartphone shipments are commonly tracked around the 1.25 billion range for 2025 by. And the AI boom. Data centers. Servers. Cooling systems. Power infrastructure. Silver shows up across that electrical backbone. Medicine. Silver's antimicrobial use is real enough that it appears in wound dressings and coatings for certain medical devices, even though evidence quality varies by application. Defense systems. Missiles, radar, communications, night vision. Silver ends up in high-reliability electronics. Now here's the critical part again. Industrial demand is inelastic. Industrial buyers aren't trying to trade the price. They're trying to secure supply. If silver jumps from $79 to $91, a solar manufacturer doesn't just stop production. They can't. Contracts, deadlines, customers. So they pay the $91, absorb the cost, pass it on. Production continues. Demand continues. That's completely different from investment demand, where an investor can say, "Hey, I'll wait for a dip." Manufacturers can't wait. For them, availability matters more than price. This inelasticity is what can trigger explosive moves in commodity markets. If demand doesn't react to price, then either supply has to increase or price has to go high enough to destroy demand. And for silver, demand destruction might require wild levels, $200, $300 an ounce or higher, because the silver cost inside a $50,000 EV or a massive solar installation is still a small fraction of the total cost, and bringing new supply online takes time. Getting a new mine from discovery to production can take 10 to 15 years, so in the next 5 to 10 years, supply can feel fixed while demand expands. That's why rationing happens. And the $91 physical price in China is exactly that rationing mechanism at work. The market is saying, if you need silver right now, you pay $91. If you can wait, you pay less, while risking you might not get metal at all. So buyers choose urgency. They pay $91, and that price sets a new floor. Now let's get practical. Monday morning, you need a battle plan. Specific signals to watch. Signal 1. Does the COMEX price move up and stay above key levels? If COMEX opens at $83 and holds above $81 through the morning, that's scenario A. Paper chasing physical, shorts covering, momentum building. Holding is more important than spiking. A quick spike to $84 that dumps back to $78 means sellers still have control. But if price grinds to $83 and holds, then $84 and holds, that's sustained buying. Watch hourly closes. Higher closes mean momentum. Signal 2. Do physical premiums stay high? That's your validation. If Chinese dealers lower prices on Monday, maybe physical demand was temporary. But if Monday afternoon hits and they're still asking $91 or more, it confirms demand is real and sustained. Signal 3. Does the spread shrink because paper rises or because physical falls? This tells you who's driving. If COMEX jumps toward $86 while China stays $91, paper is chasing physical, scenario A. But if China drops to $82 while COMEX stays put, physical capitulated to paper, scenario B. You want to see paper rising to meet physical, signal 4, signs of inventory stress or supply issues. Look for delivery delays, refineries rationing supply, mints suspending sales, classic signs of physical tightness. CME itself publishes delivery notices and warehouse depository stocks, which is where the market watches for signs of stress. If someone tries to take large delivery from COMEX and runs into trouble, that's big news. Signal 5. Volatility character. Huge swings suggest a battle. A steady grind higher suggests buyers overwhelming sellers. A massive dump that doesn't recover suggests sellers won the day. Now interpret it. If signals 1, 2, and 3 point to scenario A, paper chasing physical, then the repricing event is happening. Expect momentum as shorts get squeezed and media finally wakes up. We could see prices aim at $91, $96, maybe $100. If signals point to scenario B, paper smashing down, it might mean physical wasn't as strong as it looked. Expect pullback. But even then, if physical premiums stay high, it might just be setting up an even bigger move later. A failed smash is the most bullish setup because it proves physical demand is real and paper suppression is temporary. If you're positioned in this market, here's what you need to know. If you own physical silver, you own the real asset. Don't panic if Monday brings a price drop. The long-term fundamentals haven't changed. That $91 price in China is a stress signal. If you're trading with leverage, be extremely careful. Monday could be wild. You can get stopped out even if the long-term trend is up. Consider reducing leverage. And let's talk straight. If you're currently in a trade, you need to seriously consider widening your stops, or maybe better, step aside and wait for clarity. What's the real cost of missing one day's move? Tiny. Compared to the catastrophic risk of getting wiped out? Not even close. If you're holding a short position on silver, you are in an extraordinarily dangerous spot. Risk to reward is terrible. Best case, you make a few bucks if price dips. Worst case, COMEX gaps up to $86 and you take account-destroying losses. The prudent move is to cover the short, take chips off the table, and wait. And if you're sitting in cash waiting for the perfect entry, understand. Waiting for perfect might mean you miss the move. If COMEX gaps to $86 and screams toward $91, that pullback you're hoping for might never happen. Or it's a tiny $2 dip that lasts 15 minutes before it rips again. Physical shortages don't give comfortable entry points. They give violent, explosive ones. You either get positioned ahead of the move or you chase it higher. And chasing usually ends with you buying near the top. So here's the bottom line. Seeing physical silver at $91 in China, while COMEX sits around $79.59. This isn't a retail markup you can dismiss. It's not temporary noise. It's a major stress signal. It's the physical market screaming that supply is tight, demand is urgent, and the paper price is flat out wrong. History shows, when the physical market starts leading, the paper market eventually follows. And it doesn't follow politely. It doesn't happen gradually on a smooth chart with perfect support lines. It's forced. It happens through gaps, cascades, brutal short squeezes, and chaos. And this coming Monday morning is when the market will be forced to decide, will the paper market successfully defend its $79.59 narrative? Or will the undeniable reality of physical force paper to acknowledge $91? One way or another, Monday answers the question silver has been dodging for years. Which market is real? Which price reflects actual supply and demand? Which system holds ultimate authority? For decades, the answer was simple. COMEX had authority. Physical markets were a sideshow. But that hierarchy is cracking right in front of us. Physical markets, especially in places like Shanghai, are asserting a completely different price. And if that price holds, and Monday confirms that $91 level, then authority has shifted. Physical leads, paper follows. And that massive repricing everyone said couldn't happen becomes inevitable. All right. Quick and simple. If you want me tracking this in real time, breaking down Monday's open, watching those signals and calling out what it means as it happens, hit like, subscribe, turn on notifications, and drop your take in the comments right now. Does the gap close up or does it close down? Don't blink. Monday's going to answer it.